When an aggressive macroeconomic catalyst hits the order book, price enters a state of hypervelocity displacement. It prints consecutive, massive expansion bars, ripping upward into empty space. Retail traders look at these vertical moves and attempt to fade the momentum. They assume the market has moved too far, too fast, and they base this assumption on lagging mathematical tools, most commonly momentum indicators like the relative strength index. This split-screen visualization shows why those tools fail in parabolic conditions. On the left, the RSI quickly hits 90 and flatlines in an overbought state. On the right, price ignores that calculation completely, continuing its aggressive upward climb without a single pullback. The indicator flashes a warning, but the actual market structure remains intact. Traders relying on that false exhaustion signal step in front of the trend, execute premature short positions, and watch their capital get systematically destroyed by the ongoing vertical expansion. We need a way to measure the physical limit of this price extension. This requires a shift in focus toward the statistical variance of the asset, quantifying exactly how far price has detached from its starting point. To survive these vertical environments, a quantitative operator discards lagging indicators completely. The focus shifts to quantifying the exact mathematical distance between the current price and its established institutional center of mass. This chart strips away retail indicators and highlights the true structural starting point, the volume-weighted baseline. We define this using the hourly 34 and hourly 55 exponential moving averages. We classify these specific lines as the macro core. They represent the institutional center of mass for any given asset over a sustained period of time. In the reality of daily trading operations, this core is the primary zone where large portfolio managers accumulate block sizes. It is the specific mathematical region where the market finds resting equilibrium and liquidity is thickest. These moving averages act as a dynamic gravitational field. The asset fluctuates around this core, but the baseline exerts a constant, measurable pull on price action. Mapping this baseline is mandatory before any counter-trend trade can be validated. Every aggressive vertical overextension is mathematically tethered to this core, and any reversion strategy relies on knowing exactly where that core is located. Once the core is established, we measure the physical displacement of price away from it. We call this metric elastic variance, the real-time mathematical gap between an accelerating asset and its baseline. Rather than guessing when a move is exhausted based on visual fatigue, quantitative operators track this exact displacement using statistical bands. This chart tracks the expanding standard deviation of the asset as it pulls away from the core. The outer boundary of these expanding bands is a precise mathematical red line, the 3 sigma, or 3 standard deviation, variance limit. When price aggressively strikes this 3 sigma boundary, the system registers maximum mathematical overextension. The rubber band is pulled as far from the center of mass as physics allow. In practical terms, breaching this boundary indicates a specific failure of capital. The aggressive buying pressure that fueled the vertical expansion has completely exhausted the capital allocated within the current statistical distribution. The fuel is gone. The 3 sigma threshold is the only metric that dictates true structural exhaustion. The exact moment price pierces this level, an operator's posture shifts instantly from following the upward trend to preparing for a violent reversion. To understand why the reversion is violent, we check the actual order book at the 3 sigma limit. This visualization of a depth of market shows how institutional market makers react. When price hits that extreme upper boundary, massive clusters of resting limit buy orders instantly vanish from the rows below. Market maker algorithms recognize the statistical extreme. They abruptly halt their aggressive buy execution programs and pull liquidity out of the bids to rapidly rebalance their delta inventory. Removing those bids creates a structural void behind the price. We define this as a friction-free vacuum, stretching entirely from the current overextended peak down to the baseline core far below. The physics of this are straightforward. Without resting bids beneath the price, there are 0 structural speed bumps. There is no local support available to catch falling price action. Because price must fall through a completely undefended structural void, mean reversion at this stage enters a state of extreme high probability. Price moves rapidly through the void because no structural defense exists to slow it down. Operating in this specific environment demands strict tactical rules. The first operational law is absolute. prohibit trend chasing. Once the 3 sigma boundary is touched, any further long exposure is strictly invalidated. Reaching the 3 sigma threshold serves as a critical alert. Entering a short position still requires waiting for the market to confirm that the reversal has officially begun. The execution requires a precise lower timeframe trigger. We drop to a 5-minute grid and wait for local microstructure exhaustion. We look for a clear piercing of the boundary line, followed immediately by a bearish candle that closes sharply below the microtrend structure. That specific lower timeframe candlestick close identifies a shift in the local supply-demand balance. It signals that the last wave of trapped breakout buyers are finally giving up and aggressively hitting market sell orders to exit their positions. This specific close ignites the snapback entry. The short position is executed, and an ultra-tight stop loss is placed just 1 tick above the newly established structural high to eliminate risk. Forcing the 5-minute chart to prove that the thermodynamic snap has officially begun is how operators protect their capital from tail risk blowouts while positioning for the collapse. Once the snapback triggers, price rapidly descends into the liquidity vacuum. With no institutional bids resting below to absorb the selling pressure, the downward slide is violent and frictionless. This wide view chart illustrates the strict take-profit rule. We do not trail stops or guess the bottom. Resting limit orders to buy back the position are placed directly onto the coordinates of the incoming hourly 34 and 55 EMAs. This collision is the exact moment the elastic variance gap closes. The mathematical stretch is relieved, the overextension is resolved, and the asset physically returns to structural equilibrium. Down at this baseline, the order book repopulates. Institutional portfolio managers step back into the bids to reload their core block sizes, completely filling the vacuum that allowed the slide to occur. The kinetic framework operates in a strict chronological sequence. Establish the macro baseline, identify the 3 sigma overextension, confirm the order book vacuum, trigger the 5-minute structural shift, liquidate at the macro collision. By discarding lagging oscillators and quantifying exact elastic variance limits, an operator steps out of the parabolic trap. You stop guessing when momentum will end and start executing precision reversions driven by order book realities.